Preservation is important because in the pursuit of trying to grow wealth, most investments go into financial markets, or let's say what you call different asset classes. When they do this, sometimes you can get carried away and you start taking risks that can literally annihilate your portfolios. And that's where the concept of the 100-year portfolio comes in. You want your portfolio to survive your great-grandchildren. That's about 100 years. So when you're faced with the challenge that you need a portfolio that will not die, right? I used to call it the cockroach portfolio. The history of the animal kingdom is such that it is the longest surviving animal. We believe quant investing is the way forward. We believe that being able to make decisions speedily based on certain algorithmic premises is how you will make money.
Hi everyone, welcome to today's podcast episode of Eqtalks, where we speak with the leaders of the financial services industry. Today we're speaking with Mr. Ashutosh Bishnoi, Director at Multi-Act. Multi-Act is a leading investment research house and a renowned provider of PMS to family offices and UHNIs. Thank you so much, Ashutosh, for being here today. It's an honor and a pleasure.
Thank you. Thank you for having me.
So today we're going to be talking about preserving wealth for the future generations and the concept of the 100-year portfolio. A portfolio that's not just built to weather market conditions, but also to grow and preserve wealth. So if you could shed some light on the concept and how it came about and why is it so difficult preserving wealth for the future generations?
Certainly. Thank you, Namrata. All over the world, including in India, people who have wealth, and when I say wealth, it's wealth that is substantially higher than most other people's, savings. And people of wealth live with this challenge that they need the wealth to survive. Not just survive, but also to grow nicely. I mean, what's the purpose of their whole pursuit? And typically these are people in business, the entrepreneurs. They could be highly accomplished professionals and experts of some specific domain. And the reason they do this is two things. One, they like to do the business or the enterprise or the expertise that they have. They like it passionately. But they also clearly want to create a lot of wealth. Now, what use is that wealth if you create it and it sort of vanishes in front of your eyes? Why would that happen? Fundamentally because there is inflation. And, generally speaking, governments like to underreport inflation. But when you're running a business, you know that what's the value of your money from one year to the next. And in a country like India, if you pitch it somewhere in the long term at between 7 and 8%, if you did nothing about your money, roughly 10 years later, it will be worth nothing.
Yeah.
That's how fast it erodes. So business people understand this and they need to preserve and grow it. Preservation is important because in the pursuit of trying to grow wealth, most investments go into financial markets, or let's say what you call different asset classes. And when people put money in different assets, the expectation it will give them some kind of a return, Equities will give them dividend or capital gains. Fixed income will give them interest. Real estate will give them rent or upside on the capital. Commodities will give them trading advantage. So when they do this, sometimes you can get carried away and you start taking risks that can literally annihilate your portfolios. We saw some of that happen in our lifetimes, at least. In India, it's happened at least 3 times. The most recent was in 2008, when the global financial crisis caused a liquidity crunch and markets just, nosedived from 50 to 70%. And if your money is in that market, you're going to have not much wealth left. So intuitively also, families who have done this over generations understand that less than 5% of seriously wealthy people are able to migrate their wealth beyond the 3rd generation. It's a reality of the world. And you intuitively know that this happens. So you pit yourself against that benchmark and say, I'll do better than this. And that's where the concept of the 100-year portfolio comes in. You want your portfolio to survive your great-grandchildren. That's about 100 years.
Yeah.
Right? So if you work from that concept, you begin to make choices which will be very different from making the aggressive sort of choices. And so that's where the concept comes.
Okay. So you spoke about the 2008 financial crisis. How have the recent economic trends, pertaining to also certain crises, changed the dynamic of long-term investing?
So something very interesting happened. If you think about the financial markets everywhere in the world, at least let's say the big markets, India is one of them. Generally speaking, the market cycle from a boom to the burst is anywhere between 12 to 17 years. In some markets it's lesser, some markets it's more. In some markets, each cycle is different size. In this time it will be 12, next time it will be 15. It's very difficult to time this. This is a natural cycle. Okay, so when there's a bull market, it will end and you will enter a bear market. And the purpose of the bear market is to cleanse the financial systems of such companies and investment opportunities that need to be killed, that don't need to survive, which are inefficient, which are not going to give good returns. And it's a bit like a forest fire. The reason this happens is so that the new cycle begins. So like in a forest after a fire, all the dead wood and all the dead leaves are gone. The ground is dry and clear. It receives rain and receives seed, and a fresh new forest grows, right? Capital markets works exactly like this in the bull and bear market. Now, something very curious happened in 2008, that central bankers around the world, when the bear market signal came, they decided to push it back, right? So in 2008, I think the US market would have been seeing the end of about a 15 to 16 year bull market, which is a natural cycle. However, the political will wanted to work against the bear market, and they tried to push it back by infusing liquidity. And surprise, central bankers around the world joined in, right? And they tried to push back the bear market. And all these years later, we are 16 years later, they show no sign of allowing the bear market to come in. And the fact remains that the bear market will come.
Yeah.
Because ultimately, how much liquidity will you print and infuse? Because there are other challenges that begin to come up. We're already seeing that, right? Inflation, political wrangles, value of currencies, it plays havoc over a period of time. So we know that a bear market is going to come, and an intergenerational bear market, as far as we are concerned, around the corner. When I say around the corner, it could be anything from 90 days to maybe 18 months. We don't think it's beyond that.
Okay. And so what are the multi-acts strategies to create this 100-year portfolio?
Right.
And withstand all these conditions?
So when you're faced with a challenge that you need a portfolio that will not die, right? I used to call it the cockroach portfolio. The history of the animal kingdom is such that it's the longest surviving animal, longer than dinosaurs, because it adapts very quickly. So you need a portfolio that can do that. Let's call it an all seasons portfolio. To us, over the 40 years of investing that we've done, we found that an equal weighted portfolio in equities, high quality, long value equities, in extremely high quality fixed income or fixed income like securities. So when I say fixed income like, take for example, if you invest in the equities of a transport undertaking or a telecom operator or an electricity provider, all these kind of companies are regulated by government on their price. There is an upside, a top side is limited. They are regulated priced. When they're regulated pricing, you can be sure that you can expect a specific return, right? And therefore, they are almost like fixed income in their behavior. They're not going to be like, they're going to run away with a 100% return. They'll be in the fixed income like range. So fixed income covers those. And another quarter or 25% in what I call cash and cash-like securities. High quality cash. Now, to us at Multi-Act, we've come to the conclusion that the highest quality cash there is in the world is gold. Because it's been the currency of the world for like more than 5,000 years, maybe more. And it's the universal currency of the world. So, but if you can find something that is going to be better than gold for the time being, you should use that. Bullion is a good thing to use, but it could be from time to time different currencies. And the fourth is real assets. When I say real assets, it will include real estate certainly, but it also includes, different kind of commodities. It could be base metals, it could be, chemicals, it could be oil, it could be agricultural commodities. Now in India, you don't get so easily are not able to trade in all these things.
Yeah.
But globally, this is very easy to do, right? So a equal weighted portfolio will end up compensating for losses because each of these asset classes don't move in tandem. All four never move in tandem.
Yeah.
And they will move counter-cyclically to each other. Time to time, any two may move in tandem with a lag. But generally speaking, they are what you call non-correlated.
Yeah. And
when they're non-correlated, you can be sure that your portfolio will take some dents from time to time, but it will bounce back. Because if equity is doing poorly, maybe some currency will do very well, right? So that's how you build. That's the whole philosophy behind building a 100-year portfolio.
Okay. And you were talking about these four asset classes. So how is that structured?
So when we take 25% of each, it may not be possible in all markets.
Yeah.
For example, in India, it's very difficult to take a reasonable exposure in real estate and commodities. When I say reasonable, it means commodities, there's not enough to take an exposure in. There's not traded commodities are very few. And you can maybe buy futures, but those are very short term. The whole purpose of creating a 25% 100-year portfolio is hold it for a long time.
Yeah.
Real estate, on the other side, there's a lot of supply, but it suffers from a deep liquidity challenge in India.
Yeah.
It's not the same in even neighboring countries, not Singapore, Hong Kong. You can trade in real estate assets very quickly. We don't yet have that kind of a market. So generally speaking, then what you do in real estate is to identify the highest quality real estate that you can find in your location or anywhere else. Invest and stay put, right? So if I had the money, I would buy an office complex in Bandra Center, right? We know that this real estate is going to be premium for a very long time, at least a reasonably long time.
Yeah.
I mean, Nariman Point used to be that, but 40 years later, it's not there. So, but at least you have a 40-year, 35, 40-year horizon. If I have to buy a residential real estate, I should buy it on Altamont Road or Malabar Hill, even if it's a small place, because, that will give sustainability, because in the absence of liquidity, you need the highest quality. In other markets, you have REITs, you have real estate funds that are listed, so you can trade quickly and, you can exit. That's how you do. But in India, what we advise families to do is for some of these assets, don't look within India. It's amazing that the number of large family offices and family investment portfolios that do not have exposure outside India.
Yeah.
It's a very strange, it's a very quirky situation as far as the globe is concerned, because world over, that's not true. World over, the adventurers into other markets with their investment portfolios are actually the families first. Institutions follow later. Institutions like a very stable, government, very stable policy framework. Families are more nimble-footed. They can go into newer geographies faster.
Yeah.
But Indian families haven't done that. I meet so many families who are 100% business in India, money also in India. That's like doubling your risk, isn't it?
Yeah.
So we encourage them to look outside within the framework of the law, what it permits. And it's possible to do a lot. I mean, there are few families we have advised who've taken exposure in some of these other asset classes outside India successively over a period of last 25 years, and now it's a reasonable percentage.
Yeah.
Every year it was maybe 1 or 2%, but 25 years it is a lot, right? So that's an opportunity which a lot of families don't look at. At Multi-Act, we've been a global investment manager and investment advisor. We track securities world over, markets world over. We draw connections between what happens in other markets, and as a result, what happens in other markets as a consequence. Clearly, I should say the big 5 or 6 economies and the movements of money in those economies, US, China, Japan, Europe, India, this matters to the rest of the world as well. So if something moves in the US, like like the Fed cut the interest rate surprisingly by 50 basis points, it's affecting India.
Yeah.
Right? It's affecting China, it's affecting Japan. We track as to how it does. About a month and a half ago, surprisingly, the Japanese central bank raised interest rates. Right? And they're not known for doing that. They can ill afford to do that, but they did it. That had a ripple effect on all the investments worldwide, because most investment managers used to buy the Japanese currency for making their investments because it's the cheapest currency to buy. It has 0 interest rates. So, you'd rather go there and not pay the price of the currency.
Yeah.
Suddenly they put it up. And therefore people had to undo their investment deals because now it had become, more expensive.
Yeah.
So we study these trends, and they're all interconnected. What happened in Japan is going to affect what happened in India or happened in Africa also.
Yeah.
Because those investments would have been made in Africa.
Yeah.
So you need to understand the interconnectedness. We do it all the time. And we do this research with the help of about 35 investment professionals that we employ now. We created a very large research framework which covers the globe. We cover about 8,000 securities globally. I'm not aware of any research house or brokerage house or investment manager, except of a global scale, who does that.
Yeah.
But we do it because we know that families need to look at the whole world.
Yeah.
And of course, now there are Indian families that have substantial businesses outside India, and they have money outside India to invest. The research works on very specific, measurable parameters of investment. We don't make any investment on an impression.
Yeah.
In fact, the whole purpose is to keep behavior out. So I'll tell you, a very strong behavior that happens is, a family has a young person, he's got a lot of money to invest, and the family's told him, okay, go do something with this money, right? And then all his friends and all the investment managers and all the other distributors are coming and saying, this is the big deal, this is the new thing, this is what's going to happen, this is going to double. We saw a lot of this happening at the time of the e-commerce and IPOs in India, right? And we kept telling people quietly, based on analysis, that look, wait, we're not saying it's a bad business, but this is overvalued. You shouldn't be going in now. You will be able to get this cheaper. We are sure about this. But it was a FOMO effect, like you young people call it now, and everybody jumped onto it, and you saw what happened.
Yeah.
All the money. It's a permanent loss of capital. You're not going to recover that capital.
Yeah.
Maybe you can afford it, but you still feel very stupid having done it.
Yeah.
So preventing those kind of accidents is our job.
Yeah. So you were talking about how the Indian families, are scared of global diversification, and even the lack of research that goes behind people who, just jump on the bandwagon and want to invest in the bull market, momentum investing. So I understand that Multi-Act is, very, very inclined, and their fundamentals are analytical rigor and deeply backed research. So if you could, shed some light on that.
So we created a framework. We call it the Global Rational Analysis Framework. To us, an investment decision must be based on facts and not on behavior, which is very contrary to the market straight away. This is a market of herd behavior, right?
Yeah.
That's the way the market makes money. So if you can afford not to take that view, you will make more money in the market, is the logic. So we said most people who make investments in the markets use some kind of a system, right? Like you said, momentum. So momentum is backed by something called technical analysis, right? So people look at technical analysis charts and they'll tell you with great confidence this is how much the stock is going to be at in so much order of time. They may not be wrong, right? And many of the people make money out of that, but not always. So we said, look, why use only momentum? Let's use fundamental analysis. Let's use momentum analysis. Let's use behavior analysis, which means let's watch the behavior of the market and then use that behavior to work in our favor by going against it. And let's also use quant analysis, which means, and quant according to us is the way of the future. We believe that stock pickers, which is how we see most active fund managers today, their days, is waning, is going. Because information is what they trade on, right? Knowing better than the rest of the guys. And we think the information arbitrage is gone. Artificial intelligence will ensure that in maybe less than a year or 2 years, that information arbitrage does not exist. So you're not better off than the market. Then you'll get market-like returns. We believe quant investing is the way forward. We believe that being able to make decisions speedily based on certain algorithmic premises is how you will make money. We keep testing these things. So we've been testing, for example, 12 quant portfolios. About 5 years ago, we funded with our own money, one of them. So that's how we operate. Anything we suggest to the clients, we first put our own money, see it through one cycle, and then take it to the clients. Because ours is also a family office of our own founders, right? And whatever we do, we think is what others should do. So we're not against momentum investing, but I think you should use momentum. So there are 3 questions to ask before you make an investment in a security. Is this a good company? And the answers will come in 5 or 6 parameters. There's no one answer, right? When it says, say it's a good company, it talks about the fundamentals of the company. Is this the right valuation? It's so important. I mean, I know people who bought the best companies in the world. I mean, I know somebody who bought Nvidia and is losing money on it because he just bought it at the wrong value. He bought it just before it fell. He had this great FOMO effect, thinking that I'll lose out on this.
Yeah.
And now he's suffering. So great company, great business model, very good cash flows, but very poor valuation was bought at. So valuation is important. And there are 5 or 6 parameters of valuation to look at. And is this the right time? And the timing comes from momentum and from behavior.
Yeah.
If everybody is going after this, like alarm bells ring in our head, we put numbers to it. If it reaches at this level in this period of time, get out of it. Don't touch it, right? The herd actually goes after it and creates what we call tail risk. Tail risk is any cycle extended beyond its natural time because of behavior.
Yeah.
Right? So tail risk management is what we do extremely well.
Right. What are some other macroeconomic trends that investors should be wary of? And how does Multi-Act incorporate these trends into their portfolios as well?
So economics is something which is very dear to us, and a lot of investment managers don't think about it much. I don't know, you study economics, right? You're a finance student. So normally, you in school and college, you study Keynesian economics, Marshallian economics, right? Because those are the models that got adopted after the Second World War, when the world reset its priority on how will we manage the world, right? So there was a very long conference in a place called Bretton Woods in the United States. It almost lasted, I think, 75 days. It was presided over by no less than a person than John Maynard Keynes. He was invited by the US Fed and the US Finance Secretary to come and help, and more than 150 countries were invited to it.
Okay.
How do we rebuild the world? So the concept of the International Bank of Reconstruction and Development, which we now know as IMF, was born out of this. The currency exchange system that we follow now, it was created then in that conference. So a lot of economists, a lot of deep thinkers went into this. They also created a very interesting premise on the currency of trade for the world, and they chose the US dollar over the pound sterling, which, because of the empire's reach, was the currency of the world until then, besides gold. So some fundamental shifts happened. Knowing what that did and how that affects you today is so critical and important, because Lord Keynes said general theory of employment means demand and supply will meet each other at some price, right? So price equilibrium is arrived at by demand and supply. He forgot one very important thing, which we as Austrian economists know and believe, that the most important indicator which he missed out is actually the money supply. Demand and price don't exist in isolation. So if lots of money is there, people will pay whatever price. And if money is less in supply, then they will stop. And price equilibrium will be at a different point. So most of the economists of the world hold money supply in a simple phrase called ceteris paribus. You read that phrase. Other things being equal. We don't think you can hold money supply as being equal, because money supply changes, as we're seeing now. Because it is politically expedient to control money supply for politicians, for governments and central banks, to control inflation or deflation in their currencies and their economies, to create employment, or because that's how politics works. But we believe that following the Austrian school is a natural way of economics. And what we are seeing now in the world is natural economics rising against artificial economics. So we believe that following this natural economics is so critical to understand what's really happening in the world and the economy, and how that will affect the world. So governments can label inflation numbers. That doesn't make it the real number. You really must go down to the brass tacks and see what's really happening, right? So that's the difference. So economic analysis, when we do, we look at the brass tacks. This is what is going to finally affect the investment
anomalies
scenario.
Are anomalies for a reason.
The government policy then becomes sort of a parameter to judge it against. How far different is the government from the reality on the ground? Well, they're not always far, right? Look at this. The governments are staffed by really bright people, right? And many of them are scholarly. I mean, if you think about all the IAS officers, I'm sure I could never have made it. I'm not bright enough, right? They're really bright people, so they do the right work. It's just that they need to drive the economy in a certain direction, and they have to take certain decisions. And we have to take different decisions. So looking at economic fundamentals of an economy are so crucial today, even more, because we spent the time between 1989, when the wall came down in Berlin, to now, roughly now, making the world a global economy, right? And now it looks like we're going to deconstruct that parameter, that whole paradigm of it being a globally connected economy. I used to give the example to people that, there is nothing in a Nike shoe that is made in one country. Absolutely nothing. It's finally put together in China, right? The brand belongs to a US company out of Seattle, right? Or no, not Seattle. And, the upper is made in some other country. The laces are made somewhere else. The sole is made somewhere else. The glue is made somewhere else. And it all comes together to China. That's how it was a perfect example of an interconnected world economy. Now that's changing for whatever reasons. So therefore, understanding how that's going to affect your business and your investment is very important. Because ultimately, investments are a derivative of how business will do. Over long periods of time, the return you get out of a stock is the earnings that the company will make for its shareholders in its P&L. It will be approximately the same number.
Okay. So you spoke about the 100-year portfolio, the 25% allocation strategy that multi-act follows, the cyclical nature of the market, global diversification. Would you like to just summarize it? for our viewers?
Yeah, what I would say is that You must recognize when you are in uncharted waters. And it takes long experience to do that. And if you haven't been there long enough, you must listen and learn from people who've been there. We are in uncharted territories across the world in investment markets. I do not believe for a moment anybody knows where this is going to end.
Yeah.
Except now it's clear to most people that this is not going to end well. In 2008-9, people used to think they were out of this. And when you're reaching there, then all the alarm bells, as far as we are concerned, are ringing. That, this is overheated, this is oversupplied, the valuations are far too rich. You must listen to those alarm bells. Behaviorally, that's where you fail. This is not a time to fail. I was told that motorcycle repair garage got some 1,000 times or some such atrocious number subscription to his IPO when he was trying to raise some 10 crore or something. That's a great alarm bell to listen to. It tells you that this is going to go crazy and you must now reallocate in a sensible way. And if you're a multi-generational family, you have a lot more at stake.
Yeah.
Once, because if it's gone, it's gone. Once it goes down that path where the capital is wiped out, all the hard work that your parents, grandparents, and great-grandparents did will come to nothing. So you owe it to your future generations to do it right. You don't want to be remembered as a person who the future generations said, that guy, he did us in. He's the one we have to thank for the penury we live in, right? So that's the only message I have.
Okay. Thank you, Ashutosh, so much. I just have a couple of questions for you. So does the same strategy apply for a multi-generation as it does for like a retail investor? Or do you have to relook at, because the corpus might not be so huge?
It's never a question of corpus. Any amount of corpus to any individual person is as dear as it can be.
Yeah.
Generally speaking, since we are a young economy, and there are more young people than old, most of the people in India are not saving for the third generation. They're saving for self-consumption.
Yeah.
The horizons are shorter, and therefore they should work on a shorter horizon. Do not have a 100-year portfolio, please.
Yeah.
Unless you have already great-grandchildren and everybody is doing well and you still have a lot of money. So if you're young, well, please by all means plan on 3-year, 5-year, 10-year, because those are likely to be your family goals. You want in 3 years' time, to be able to fund schooling for your child for the best schools. In 10 years' time, maybe you want to be able to buy a house. Yeah, in 15 years' time, maybe you want to send your children on to professional education. Right? In 25 years' time, maybe you want to fund somebody's wedding. That's very uniquely Indian. It doesn't happen anywhere else in the world. So, but these are goals, right? Life goals. Yeah. So you set time-bound goals, but to set goals. And as you're approaching those goals, make sure that you take money off the table when you need it.
Yeah.
Because market cycles will otherwise take it away from you. If you haven't had good advice and you're riding the momentum, please learn to recognize that the momentum is waning. Trying to get to the peak in the last burst of energy is the poorest show I've ever seen, but it keeps repeating itself. People keep losing money, and you don't want to be the deadwood and the dry leaf when the wildfire comes. You want to be the tall tree.
Yeah. So basically, the fundamentals remain the same.
Yep.
Your
horizon changes.
Yeah.
Your goals change. Yeah.
Thank you so much for that, Ashutosh. So as you've mentioned today, the 100-year portfolio is not just about surviving the market cycles. It's also about thriving in this economy and preserving and growing your wealth. Building wealth that lasts across generations, it's important to, have the right strategy, have the right research, have the right people investing your money for you. So thank you so much for being here today. It was an honor and pleasure.
Thanks for having me.
Thank you so much for watching today's episode of Eqtalks, where we spoke about investing for generations with Mr. Ashutosh Bishnoi. To hear more such interesting conversations with inspiring leaders, stay tuned for our upcoming episodes.